not a big surprise, that rebound in Liberty, because we saw it coming through at the half-year stage, and really everything was pointing towards this.
Yes, I think, and last time as well, they did report a loss, so it's difficult to do worse than that. So a good turnaround for the group. I guess the question is, where to from here? And a couple of the key indicators in the business still not looking good for us. If one looks at the new business that they're generating, and the margin on that business seems fairly lackluster at this stage. And I think it's maybe a business that's in terminal decline. We've seen it being leapfrogged by the merger of Momentum and Metropolitan in terms of the ranking. I think it's the fourth biggest life for sure now. Discovery can't be too far behind, and I think I'd rather be in a business like Discovery, where there's innovative management, innovative products, and there's high growth optionality for Discovery offshore.
Of course, you pointed out we also had results out today from the biggest company listed on the JSE. Of course, there's not one that's included on the top 40, that's British American Tobacco. 15% rise in earnings, and it's also announced a big share buyback, £750 million.
Yeah, it was quite amazing to see what happened to the share price when the results were released, because the markets beat expectations, adjusted headline earnings up 15%, but the share quickly traded off down 4%, and that was on the back of the share buyback program that the company announced. Historically, management have got a history of buying back shares, and we saw Philip Morris report a couple of days ago, and they also announced a buyback program, and that buyback program amounted to about 4% of their market cap. The one that British American Tobacco announced was about 1.6% of their market cap, or I think the program in total was about £750 million. So there was some disappointment in the buyback program, and I think also comments from management alluding to the fact that they expected cigarette volumes to be about 2.5% lower for the year as a whole globally.
Let's leave it there just for a moment. We heard it from the Finance Minister yesterday. There's still a number of risks out there that could hamper efforts to grow the economy and reduce unemployment, including surging global food prices and energy prices and the recent events in North Africa. So is this a risk that spreads to all emerging markets? Joining us with his view, Tristan Hanson. He's Head of Asset Allocation at Ashburton. Tristan, thanks very much for coming in today. To some extent, this rising inflation that we are seeing globally has been exacerbated by the events in the Middle East at this stage, by the floods we had in Australia recently, which pushed up soft commodity and hard commodity prices. Do you see this as a temporary phenomenon?
Well, the recent developments in North Africa won't have affected inflation just yet, but clearly people are worried about a rising oil price and the implications of that for inflation around the world. Yes, in terms of food prices, there clearly has been a temporary element given the large weather effects we've seen in Australia, Russia, China, and also in Argentina as well, and the La Nina effect that has affected world food supplies. So yes, you would think that on a 12-month view, a lot of that will be temporary, but there are clearly some inflationary forces building in the global economy as a whole, and in particular in emerging markets.
Why are these a bigger risk to emerging markets than developed markets?
Well, firstly, a number of emerging economies have been growing very rapidly anyway, particularly if I think in the likes of China or India, for example, and therefore there's inherently a greater inflationary bias there than in the Western economies, where you've got a lot of spare capacity, high unemployment, and no wage pressure. So you've got some sort of underlying growth momentum that's causing some inflationary fears. Also, food accounts for a much larger share of the consumption basket in emerging markets, typically somewhere in the region of 30 to 40%. So rising food prices have a greater effect than they do in the more developed economies.
Well, we were chatting just a bit earlier about valuations of Massmart and Walmart, and I suppose that would go for a lot more stocks listed on exchanges around the globe. Would you look at these inflationary risks as another detractor from emerging markets and a reason to invest in developed markets at this stage?
Not in isolation, but I certainly think in terms of consumer spending in emerging markets, that is going to be a little bit of a handbrake then. But I think, from our point of view, we always need to look at valuations, and that's where we start from. And I think across the board, you finding instances in developed markets where you can buy iconic companies on dividend yields of 4 or 5%. pretty much low PEs, 10, 11, 12. And these are businesses that have got business models that have stood the test of time, generated significant returns for shareholder over time, and likely to do going so forward. So we think, and we've seen particular interest from our clients in this regard, it's an opportune moment to start picking and investing in some offshore shares.
Justin, do you think this is across the board that emerging markets are looking pricier than developed markets?
Not necessarily as a whole, and everybody in the market tends to term emerging markets and lump them into one basket, but you've actually got a lot of different things going on in individual countries. You've got oil exporters, oil importers, you've got some markets that are on higher PEs and some markets on quite low PEs. So China, for example, is only on 11 times PE multiple, so that's not an expensive market.
Is there a reason for that?
Well, China's been a poor performer for quite a period of time now on various issues related to fears about property, concerns about the banks having to raise more capital, worries about bad loans in terms of local government. These kind of issues are sort of weighed on the market. But I think we had at Ashburton, we had reduced emerging market exposure at the end of last year, early part of this year. I'm actually sceptical that we'll reduce emerging markets any further than we already have done.
How are you sitting with emerging markets at the moment? So are you neutral on them or underweight?
Well, I would say we're broadly sort of neutral, maybe a sort of modest underweight. We had been very overweight emerging markets. So we're quite fully weighted in developed markets currently. We're comfortable with that at the moment because I think there's still these inflationary pressures, some lingering bad news, if you like, in emerging markets. But actually, I think we'll probably get quite a good buying opportunity in a number of these markets. They've come off and underperformed quite a bit in the last 3 or 4 months now. So I don't think this is the end of the emerging market story by any means.
But from your perspective, would you be taking your maximum allowance offshore at this point and investing it in some of those big opportunities there?
Yeah, absolutely. And as we all know, those markets have done absolutely nothing for longer than a decade. So I think when you get the opportunity, when you see PE valuations trading at almost multi-decade lows, then it's an opportune moment. News is particularly poor, but so are valuations, and it's a good time to buy.